talking about. So if I had to guess what your structure would be in your sort of top five, it'd be tough, but I'd say uranium, oil, gold and silver, copper, and then all the rest in terms of like tin, lithium, and so on and so forth. Is that fair to say, or would you structure it differently?
Yeah, actually, it would be different. It's zero to the other things that I have less conviction. Well, almost zero.
Okay.
If there's a producer that has a cobalt credit, or and there's a copper play that has some other things in it, that gives me the upside to that, great. But there isn't anything in my portfolio right now that's there because it's a cobalt play, or that's there because it's a tin play. If you understand what I'm saying.
I do.
And it's not, going back to that, I think, key takeaway we talked about earlier. It's not that I'm saying those things won't go up. I'm saying, given that I have different choices of things that I'm highly confident will go up, I'm focusing my money on the ones that I understand and that I have my own confidence based on my own reasoning, my own analysis of the data, rather than going farther afield on these other ones. I've been accused of being bearish on everything that I don't love. And that's not true. It's just simply concentrating my resources based on what I have confidence in. So my portfolio right now is, I haven't done the math before this interview, but it's roughly 50% gold primary.
Okay.
It's roughly 30% uranium. And the rest is mostly copper and silver. I'm not sure which is more. It's hard to find great plays in either of those. Like copper, a really great copper deposit is this gigantic thing that it takes a major to develop. And so the sweet spot there is a junior that makes that kind of discovery that can sell it, but they don't last long. The juniors that have gigantic deposits that have been there for 30 years, you got to ask yourself, why is that gigantic copper deposit still there after 30 years, right? So, quality matters. Silver is just, I'm not sure what it is about silver. There's just so many of these companies that have warts all over them, and makes me very nervous. It's somehow easier to find a gold play that makes it through the due diligence. And maybe part of it is also just the world we live in now. As we've discussed before, I'm very politically risk averse. And our mutual friend likes to say, if somebody steals my wallet, it doesn't matter what the color of his skin is. I agree with that. But if your geologist is driving home from the Red Lake mine to his home somewhere in the town of Red Lake, it's not very often that he gets shot on his way home. Whereas that does happen in Burkina Faso or Mali or places. And, if I had the staying power of our mutual friend who can make a company succeed, even if he has to replace the project and replace management, replace everything, and make the company succeed after 10 years, I've seen this happen, maybe I would have a different appetite for risk. But I'm a newsletter writer, and I've got people looking over my shoulder, looking at my portfolio. And if I buy something in, AK-47 country and it drops 75% next week after the next coup, those people are not going to be happy, and I'm responsible to them. That matters to me. I'm not just going to say, oh, well, stop whining, it'll be fine in 10 years. That's a bad outcome, and I got to fess up to that. So with silver, a lot of silver is in Peru, which right now is a no-fly zone for me. Under current administration, nobody knows what's going to happen in Peru or how, things could go there. And there's other jurisdictions that have become much more alarming lately. And a lot of silver is in these jurisdictions. So that's part of the problem with silver too. Let's not beat that to death. So that's the structure of my portfolio. It's very gold heavy, but it's not because I lack confidence in the other metals. It's because it's been easier to find great bargains. And by the way, one of my recent buys in the gold space was in Africa, but I got in at literally 10 cents on the dollar, or maybe just under. The NPV for the project was just like way more than the company's market valuation. And that justified the risk in my view. That was an appropriate discount for me. So never say never on most of these places. But if I'm going to go into a dangerous area, then I want a deep discount to justify that for me.
So to go back to what you're then doing with that money of yours, something that, you talk about what you're being in cash and stuff like that. Oh, maybe that's an interesting question. You talk about being heavy on cash and sending in as much cash as possible to your broker. What is your cash to portfolio ratio like? How does that look like?
It's actually kind of low. If you asked me a year ago, I don't know if you did ask me a year ago, we might have had that conversation. I was pushing 40% cash because I thought, not quite May, but like March or so of last year, I was also concerned about a crash in 2021. There were a lot of things that looked scary then, the knock-on effects of the shutdown still going on, the new variant of the virus and so on. So I had built up a lot of cash, more than I usually carry. 40% is a lot for me. There's no right or wrong size. You know, how much cash I carry depends on my perception of buying opportunities ahead, right? So at that time, I was fairly concerned, but I wrote an essay called "The Crash of 2021?" And I think that's important. This is available for free on the website. I think that's important because as concerned as I was, I didn't sell everything hoping to buy in cheaper. And boy, am I glad I didn't, because we didn't get a crash in 2021. And if I had sold because I was worried, it would have been a big mistake. So to the audience now, I'm saying I'm in a similar place where I haven't sold anything because I think there might be a crash, because powers that be could pivot tomorrow and change the market dynamics. So I don't want to be short. But because the crash of 21 didn't happen, right? I have been deploying. You know, there were bargains available. There were things that got away from me before. They were, I thought, objectively, deeply discounted, great speculations out there. So that 40% dropped down to about 15% a month or two ago. And now I'm building it back up. It's probably back up to around 20%. The market hasn't crashed yet. Hopefully it'll give me a little bit more time to build up. But right now it's about 20% cash. But that's not because I think that's an appropriate level to have pre-crash, should we be so lucky as to have that opportunity. It's just because when the crash didn't happen last year, I saw opportunities and I took them.
Fair enough. Yeah. Well, you talk about that you haven't been selling and all that, but when are you gonna be selling? Well, what needs to happen for that portfolio to start changing from that 50% gold, 30% uranium into 80% cash, looking for a different opportunity?
Yeah, well, 80% cash. I'm not dodging the question. I'm trying to think about how to answer this in a useful and accurate way, Antonio. Objectively, I have to say, my uranium bug friends will hate me for saying this, but I could see a day where I'm, if not completely out of uranium, drastically reduced out of uranium. Because I do think that we will hit incentive prices at some point. And uranium, like lithium, it's not scarce. There's a lot of uranium around the world. It is a byproduct of some very large mines for other materials. It is the sort of thing where high prices will cure high prices. I have no doubt of that. So I think there will be a day where I'm quite lean on uranium. Maybe it would just be going back to some exploration, because the market always loves a discovery. And I could actually see that being not longer than a couple years, Antonio. So I'm not sure about 80% cash, but I could see where the uranium portfolio or portion of my portfolio goes down to 5% or less. I could see there comes a day where I don't have any uranium stocks. I'm looking for the next best one. I can see, gold bugs and silver bugs may hate me just as much, but I can see a day where I lean on that portfolio a great deal. Like if we come to a point where we're clearly post 2011, 2012 in another downturn, multi-year downturn like that for gold and silver, that would argue for lightening up. I don't want to go down with the ship. And if there is a mistake that I feel most culpable for in my past, it was being too naive about how bad that bear market could be in 2012. When gold and silver really fell off the cliff in later 2012, I was too optimistic about how soon that would recover. So it's my intention not to go down with the ship, and having taken profits on many of my big wins, I can do that. Like even if some of these stocks go, drastically lower from here, I've already got my initial funds back off the table. So even if they go down from being up, a triple or whatever, and they go down to being up only 20%, well, having recovered my initial investment, that 20% still is a win. I call this strategy the upside maximizer. That's another free download on the website. You can look for upside maximizer. There's a way of using trailing stops, not as stop losses, but as ways to lock in gains. And I think that's very important for people speculating on when we don't know the future. Here's another answer to your question, and that is almost 20 years ago when I started in this business, somebody told me a story that gold and silver were monetary metals and the industrial metals were a different creature, and they were contracyclical. And the great thing was that when the economy went down, people bought gold and silver because they were worried, and that hedged your industrial metals. But when the economy was booming and everybody was happy, okay, your gold and silver didn't do so great, but your industrial metals did great because the economy is booming. And so you had this contracyclicality there to help maintain your portfolio if you bought lots of different metals. But I think that's just basically not true. These commodity super cycles that you hear about, that is true. I do see that in the data. And the correlation between gold and copper is very high. Even the ratio extends, like gold silver ratio, they expand and contract. They do tend to move together. The commodities as a class do tend to move in these large super cycles generally together. There is a high correlation. They are not contracyclical in general. I mean, when they are contracyclical, it's short-lived. Like there's a war in Ukraine and they spike. Gold spikes, oil tanks, something like that. Well, not in this case, but in the last Ukraine war, something like that happened. But longer, aside from short-term wiggles like that, the commodities tend to move together. So part of my answer to your question was, you would think that I need to get out of metals entirely. If the whole cycle is turning downwards, well, it's time to look for something else. Maybe by then there'll be obvious winners in the DeFi space that I can jump onto, right? Or maybe it'll be obvious that Bitcoin Cash, that will be the Bitcoin to rule them all in the end, right? And I can jump on that. But no, what I'm saying is that the commodity super cycle has disabused me of this idea of hedging your metals with different metals. But now I'm actually going back to that old idea that I thought was wrong. Because of what we talked about with copper being this multi-decade structural supply constraint, I actually do think that copper could be a good hedge for gold and silver going forward. So like if the economy, there's a reflationary boom, everything's happy, happy, joy, joy, we don't need no safe havens anymore, and gold and silver drop on that basis, maybe silver drops less than gold because of its industrial demand, but both of them drop, I could actually see copper hedging the rest of my portfolio. So to answer your question, I can see a future, say 3 or 4 years from now, if the powers that be manage to get the economy going again, where my portfolio is much lighter on gold and silver, very light on uranium, if not absent uranium, but very heavy on copper and maybe some other things. We'll have to see what happens then. I could actually imagine buying, maybe not in the independent speculator portfolio, which is resource oriented, but maybe we'll see. I could actually imagine buying some of the market darlings that if there's a real crash, if I can get Amazon at 10 cents on the dollar, that would be a no-brainer to me. I mean, whatever happens to Amazon in the future, unions or whatever problem it has, it's not going away. And if I could buy Amazon for 10 cents on the dollar, I could be tempted to do that, in a different market in the future.
Of course. My dream is to have big uranium profits, take them out right on time. That is the dream, okay? Take them out right on time and buy something like the Triple M company at a 10% dividend yield. Just, that would be awesome, right? Coca-Cola at an 8% dividend yield, stuff like that. That's what we all want, right?
Have a mania in the metals and then rotate some of those wins into a Warren Buffett portfolio. Why not?